Today in this presentation, I'm going to cover and kind of apply some of the concepts that we talk about in the book, most namely developing a market cycle system. And you guys saw how Roy and Wes have worked themselves into the market while managing risk as the trend gets confirmed. And a market cycle system, I'll dive into the details and how to build your own one in this presentation, but it's really defining for yourself a set of rules to do just that. How do you, after significant correction, manage risk while re-entering the market and making sure you're participating in a strong uptrend that always comes after a really significant correction. So we'll dive into that. And also we'll do kind of a little bit of a case study, kind of how Wes was breaking it down as well, of, what have been the key news events surrounding the recent correction and what have the leaders done in response to that, and how could you have analyzed and found them early on so you can participate and enter them, of course, while managing risk. So this will be a lot of fun. I wanted to start with, of course, a quote from someone who's inspired all of us here today, from William O'Neill. These are both quotes about the market as a whole and following its longer-term trend, which is about what today is all about. So first he says, personal opinions, feelings, hopes, and beliefs about the stock market are usually wrong and often dangerous. Facts and markets, on the other hand, are seldom wrong. So this, in terms of how to apply it in current markets, is, whatever your opinions are about what the tariffs will do, like Wes said about the Target CEO saying shelves will be empty, the market looks to the future and interprets everything and comes to a consensus about what the impact, the long-term impact, 6 months from now, will be the major catalyst tariffs of the day. So the market looks past it, and we don't have to predict what's going to happen. All we have to do is actually analyze what's going on currently in the charts themselves, both the market indexes and the market leaders. That will tell us all we need to know about how exposed we should be, which stocks to enter, how aggressive, how defensive we should be in the markets. Then the separate quote, which is, just as important and really sums everything up. He says at least 50% of the whole game is the general market. So if you think about a trading system and everything that it entails, buy rules, sell rules, risk management rules, this goes to show you, coming from William O'Neill, how important it is to have a market cycle system and analyze the health and trend of the market. And that's what we'll be talking about briefly today, and we talk about a lot in the book. And we also did a free webinar on creating a market cycle system and market analysis that goes along with the book. And I'll probably link that at the very end. It's free to watch on our YouTube channel. All right. So here's a quick agenda for today. First, discussing a little bit about what's been going on recently within the context of this correction, and covering what the market index ETFs have done, and then also talking about some of the key opportunities that have come out of this correction, because after the end of every correction comes a tremendous opportunity to be positioned in the market leaders that can double, triple, or even more once a market uptrend really takes hold. So we'll take a look at Palantir, Hood, HIMS, and a few more as well, and discuss different price and volume characteristics, how to identify them early on, all those different things. And then the second half will be a little bit more, like I said, how to build a market cycle system to identify and have a really rules-based approach to become positioned in the market. Then we'll also touch on a little bit trading early in a base, how to position in those names, Palantir, Hood, HIMS, as they move up the right-hand side. And then I'll discuss the Trader's Handbook a little bit, what else is in the book, and we've got a special offer for everybody here today, and a chance to win a signed copy. So stay tuned, and we'll talk about that at the end. All right, so perfect. And I thought it was really cool. Wes, you had a very similar slide to this. Basically, what this does is I'm plotting it here on the QQQ, the NASDAQ 100 ETF, all the kind of key news headlines surrounding tariffs, because that really is the fundamental macro driving factor that's driving everything right now. During any market period, there's going to be some fundamental factor that's kind of impacting everything. It can be positive, like the development of AI that can drive long-term trends, but often when we enter a corrective phase, there's something negative overarching, happening. Back in 2019, it was actually China trade wars, again. Then during COVID, of course, it was the COVID correction, and COVID was driving things, as well as the economic impacts from that, and so on and so on. There's always something going on in the news, whether it's inflation, what the Fed is doing, that drives and has an impact on the market trends. So here, as I mentioned, and let me minimize this here, I've kind of labeled for each of these days when key news events took place. And let me actually zoom in a little bit so it's easier to see here. Hopefully, yeah, that's better.
That's correct.
So obviously, as Wes pointed out, this
Yeah.
was the big day where we saw a reinvigoration of the correction because it was Liberation Day. The tariffs were announced right here. We saw one more leg down, significant extension down here, and then towards the bottom. Obviously, we were very short-term extended. We were due for some type of counter trend rally. Whether that was going to be the bottom, we didn't know, in real time. But you kind of have some expectation when we get so extended to this that there'll be some type of bounce that will either roll over or, as we saw here, start to form higher highs and higher lows and start a new uptrend. But regardless, here on April 7th, we actually had, of course, significant extension, but then it was kind of interesting. We had a rumor it was funny. I think it actually started on Twitter where there's this news account named something and then Bloomberg after that. And he posted something about there being a pause about tariffs that was then repeated by different news outlets because his last name was Bloomberg on Twitter. And it caused this kind of algo frenzy, which if you look at the 5-minute charts or 1-minute charts on that day, you can see when that tweet hit and when it got repeated over and over again. And we actually saw what the impact would be of an announcement of a pause of the tariffs and what impact it would have on the markets. We saw a crazy rally here. It did fade, obviously, into the end of the day when that rumor was debunked. I think there was some news out of the White House that was false. But regardless, you got to see what that type of news event could actually have, what kind of impact that news event could have on the markets, which then we saw 2 days later happen for real. So the next day, still very volatile, inside day. And then here on April 9th is when we had that 90-day pause of the tariffs announced. And also, if you look at the intraday charts here, just the incredible rally that took place off those lows, reconfirming the start of a potential rally. At that point, kind of my mindset is this is a important local low. Who knows if it's going to be the low of the downtrend, but at that point, that is the significant level to trade against, to think about and measure higher highs and higher lows versus. After that period, there's kind of a week where we just have sort of kind of digested this massive bar where we consolidated within it. We tried to push the 21 EMA on the QQQ here, rejected down. We had some gaps lower, but then here on this day, we gap lower and close off lows and then reconfirm higher the next day. And this is the first follow through day that Wes and Roy mentioned. And here we got our first kind of glimpse of positive news after this one here. And it's amazing how it kind of lines up with the technicals. Here on April 22, Trump and Wes mentioned also what his cabinet member said as well. But here Trump said China tariffs will drop substantially, but it won't be zero. So a positive message. We don't know what the resolution is, but we get the first hint of really positive news regarding the relationship with China, because at this point we had kind of positive news with everybody else, but China was still the dominating factor. And of course, it's probably the most important country with regards to the tariffs, with regards to how much it's integrated into our economy and the world's economy. So that sparked this follow through day here. And we didn't just have one day of strength. We had follow through to the upside, gapping above the 21 EMA. We did close below it. But the next day we saw a reconfirmation to the upside. And then here on April 25th, we get our kind of next batch of good news regarding the China negotiations. I said here who called who, because there's some back and forth about whether China started negotiations or Trump started negotiations. But regardless, it was just kind of positive sign that there was some communication, there was some negotiation back and forth, and that talks were resuming. Then on April 30th, if we move forward, we had a gap down. And gap downs shortly after the start of new uptrend, because how I define it, and we'll talk about market cycles later on, is when we pop above the 21 EMA and stay above it. This kind of started the new technical uptrend for me. Often early on, 4 or 5 days in, we see what we call a stress test, where we see a significant down day. The leaders may be down 3-4% in the morning, and how the market handles that type of stress test kind of tells you a lot about the strength of the market and the strength of the market leaders as well. And we definitely passed a stress test, closing right near highs. All the stocks that were acting well, CrowdStrike, Palantir, they rallied and closed near highs on that day and just acted well. So after that negative news event, GDP contraction, weak jobs number, all related to tariff uncertainty, we closed strong, showing that the market was kind of brushing that off. And that's definitely a positive sign when the market ignores negative news related to the dominant fundamental factor. After that bar, we got some nice follow through up towards the 200 SMA on the QQQ, and didn't really have too much news until May 7th when the Fed maintained interest rates, citing economic concerns. Again, kind of a negative news event, but the market closed well. We saw fall through to the upside, and then tightness right below the 200 SMA. And then the weekend hit, and we had the first batch of really significant resolution news about China-U.S. De-escalation agreement over the weekend, which was implemented over the past few days. And that's been the most recent development so far, causing this really strong gap up above the 200 SMA and significant fall through here. So you can kind of see how the negative news gets announced, and then we kind of brush it off. And even before the news is completely resolved and completely fixed, the market has looked forward and seen that there's light at the end of the end of the tunnel, and started to form higher highs and higher low here, higher low here, higher low here, higher low here, and so on, reclaiming the moving averages as we go. So that's kind of a fundamental view, noting some key dates and events here that I think is always cool to look back, because every correction is similar. If you go back and do this exercise with the COVID correction, you'll see how, very similarly, before there's resolution about economies, reopening, states reopening, we had already bottomed and we're well underway, and the market looks forward. And that's one of the key things I want to pass on to you guys in this presentation. And this tweet that I put out actually on this day right here, which was funny enough, the day before we got that kind of reconfirmation positive news that really started this move higher. This tweet here kind of sums up how I kind of interpret things. And I'll just read it because I think it's a good review here. I view the markets through the lens that price action reveals all. Currently, we are in a longer term and shorter term downtrend below the 200 SMA and 21 EMA. I do consider the current dominant story that defines the risk environment. Right now, it's tariffs and trade deals. I'm no expert at these topics. However, the market looks forward and will show when it sees hints of light at the end of the tunnel. When it does, we will reclaim moving averages, form higher lows, price action will tighten, and individual leaders will set up and stand out likely before all the news is resolved and looks sunny. And then kind of the next day, that actually played out pretty well as we got reconfirmation of positive news. We reclaimed the 21 EMA, started forming more higher lows, respecting that 21 EMA to the downside, brushing off negative news as the market's looking forward, reclaiming more moving averages, the 50, the 200 SMA, and continuing higher and starting a new uptrend. So this is kind of how I interpret all market corrections. There's always something going on, but you always want to kind of put your opinions aside and just look at what the price action is telling you, and especially what the market leadership is telling you, and just listen to price and your rules, and that will help you escape the worst of corrections and participate during the best of uptrends. And then here on this slide, let me get a quick sip of water here. Instead of a fundamental view, I transitioned more towards the technical things that I was looking at, and I'll zoom in again here so it's a little bit easier for you guys to see. There we go. So obviously we had the first leg down here, and you could call this the first leg or almost the second leg because we had so much chop back in this area that was almost kind of a correction in disguise here with deep seat gap down, all of that. So whatever you want to call it, this could be the first leg or second leg. But regardless, we had an initial move lower, break below the 21 EMA. This, just like Roy and Wes, I'm interpreting the same way. This was when to get out of the markets. You're probably getting stopped out on race stops as stuff is breaking the 21 EMA. I remember I was getting stopped out of Palantir, Reddit, those leaders of that previous uptrend. And we have a significant downtrend breaking below the 200 SMA, volatilities super high, gap ups, gap downs, but overall we're moving lower. Then we had this consolidation, this range form. This becomes the local key low to measure if we're having a valid rally or not. And we did try to move out of here, but we were rejected as we tried to break above the 21 EMA, then 200 SMA, and were rejected down, and again formed a lower high here. And then the tariff gap news hit here, and we started that downtrend. But this is kind of how I interpret price action, and it's kind of a part of a playbook that I view all downtrends and transitions from a downtrend to a correction. And we'll talk about the base trading playbook later on in the presentation. But here we have extension to the downside, that then closes up. That's the first positive sign you're looking for. This becomes the key low that you're considering. Then we have an inside day that holds above this low. Again, this low is key. Then we get reconfirmation up. It is a powerful day, and important enough, this inside day closed pretty close to lows, but instead of falling through to the downside, which is where the momentum was, we rallied incredibly strongly. So that was a sign for the bulls here. Definitely a positive sign that a rally could really be taking hold here. Then we just consolidated within this massive bar below the 21 EMA. Often the first and even second rally into the 21 EMA, the declining 21 EMA, will fail, and it will set up the next higher low, which is exactly what happened. We had some tightening action, then a gap lower, another gap lower, but then we started following through to the upside and testing that 21 EMA one more time. And this time we were able to close above it, really get going, and had reconfirmation up. We had this day where, again, we hold the 21 EMA and going to have a strong close after the gap down, another positive sign. Then we rally, test the 200 SMA, pull back, tighten, form another higher low. We have a strong close here after the Fed news here. We fall through to the upside, carrying on that momentum, consolidate near the 200 SMA, and then we get a gap up and continuation up. So you can kind of see how you can look at it both from a fundamental news-driven lens, but also a technical lens. And regardless of what the dominant news factor is, the technical lens will always look pretty similar at these market bottoms if you studied enough of them. There's always extension down that gets bought up, no further price progress to the downside, higher lows form, reclaims and moving averages, there's less gaps, there's more tightness in price action, and that playbook just kind of plays out again and again. And then this is a chart that I made actually for that market cycles presentation for the handbook, and it was kind of interesting. We did that webinar 2 days after the market cycle turned on, and a lot of the stuff that we talked about a stress test, and that happened the very next day. And lucky enough, we heard from a bunch of viewers of that webinar that actually helped them immensely. They helped them stick with the positions they had during that stress test and actually buy more on that weakness. But the market cycle began here, and then what this chart is showing is basically key price and volume action moves from leadership quality stocks that goes along with this trend. And market leaders will always kind of form up and maybe make a higher low as the market forms one more lower low. And just in general, as the market forms up, you're going to see leaders kind of do the same thing, but be a little bit stronger and lead the market higher. They'll reclaim the moving averages first. They won't progress as much to the downside during that last leg lower. And basically here, again, with each day, I've noted the key price and volume moves from stocks like PLTR broke above its 21 EMA here. It had another 21 EMA. It actually had a 21 EMA pullback here on April 21 that it reconfirmed to the upside. MSCR had a gap and go on this day. Netflix had a gap and go on this day. That was a stock that was standing out. TEM had a range breakout on this day. Numerous gap ups. So you can kind of see how the market leaders are acting along with what the market's doing. Here you had GEV range breakout, Tesla breakout here, Okta 50 SMA pop. So you can kind of look and see, and there's a great exercise. I highly recommend it. Basically look at a market index along with key leaders and note when their setups really developed and really matured, and where you could have entered after the market kind of really got underway and reclaimed that 21 EMA. And then this is actually a screenshot. It's basically the information from 2 tweets that I made on April 22, which is the day of that first fall through day. And these are basically what Hood and Palantir looked like on that day. You had Hood popping through the 21 EMA, forming a clear higher low here. You had a negative close on this day, and let me zoom in so you can actually see. Hopefully that's better. You had a negative close on this day, and then on that April 22 day, you had a positive bar here breaking through the 21 EMA. Nice close. You can see how this chart looks just so much stronger than the QQQ on that same day. And from here, it was off to the races and acting tremendously well. And then here is Palantir on that same day. Look at how it rallied off the highs. Its base, this entire base is above the 200 SMA. You can see it peaking here while the market was well below it. And that's one key sign of relative strength that you want to look out for. But again, this is when the market bottomed. It had a strong undercut and rally, reconfirmed to the upside, popped to 21 EMA, and it was holding above that as the market was still, trying to push through. And on April 22, it's forming this nice range and a nice inside day here that actually pushed higher very shortly after this. And obviously, Palantir up about 40% from this point. We have an earnings gap down, but then made new highs today here as we're giving this presentation. So this is kind of what you want to see leaders look like as the market is really putting in that first higher low. Is they're at more advanced than the market and basically setting up that first EMA cross back into the 21 EMA and then reconfirming off of that. All right, so here are some key points that I want to kind of distill about interpreting the market based on the fundamental factor, what the leadership is doing, all of this. So hopefully this helps sum it up here. Price action is the ultimate decider. It interprets news and judges it. Your opinions are irrelevant. Leave your ego and politics at the door. Whatever you think about Trump and his policies and tariffs and how he's interpreting things, it doesn't matter with regards to trading. Your job is to just interpret the price action of the market indexes, leaders, and do your best to participate on the right side here. And then here, know what the key fundamental driver is that the market cares about. And note how price reacts in relation to related news catalysts. So, CPI inflation, that was huge for quite some time during the bear market. And then finally, we saw some instances where the market brushed everything off and responded positively to negative news catalysts to what the Fed was saying. So that's always what you want to be looking out for is when you know what the dominant factor is, whether it's trade wars, whether it's general war, whether it's a pandemic, whether it's CPI inflation, key news events, jobs reports. Note when price reacts much differently than you'd expect it to and starts ignoring negative news events related to that dominant factor. And then this is really key and related to that. The market looks ahead. The leaders and indexes will bottom and start trends as the light is first seen at the end of the tunnel, not when we're really approaching it and it's really clear, just when the first few signs of positive news and developments, that's when things will start shaping up. And that's when we want to start getting involved to participate at that lower risk zone when breadth is expanding, everything's spreading, we're getting those wide breadth thrusts, all of that. That's when we want to start putting on positions or be adding exposure as we go and get positive confirmation and trade confirmation. Then to really sum it up, this is something that Ross, who is a co-founder of Traderline, former portfolio manager for O'Neill, he really sums everything up with watch the leaders. If you're paying attention and watching for relative strength throughout the correction, you notice Palantir pretty early, CrowdStrike pretty early, and as they, bottomed and started showing respect for the 21 EMA and, forming higher lows and reclaiming moving averages, that was the sign that, hey, the market's going to shape up here. We're shaking off what the news is. And you can gain so much information from just watching the leaders, both to the upside as we're beginning uptrends, also to the downside as we're breaking down. And we'll actually show a slide of that in just a minute. And then the last point is, and we'll talk about this in the second half of the presentation, you need to establish a market cycle system and rules that define how you analyze the market and, position early in an uptrend to, get close to, getting positioned early in that uptrend to participate. And then also to when things are breaking down, how do you protect yourself, lock in profits, all of that. You need rules to define that market cycle system so you can do that repeatedly, hopefully just like Roy has over 35 plus years in the market. These rules are going to apply over and over again. We're going to see the same show where market leaders break out at the beginning of an uptrend, and then eventually we top and things roll over and all of that. And you need to come up with rules that encapsulate the key moments there and tell you how to act, how to sell into strength or how to sell into weakness, how to buy, early in an uptrend. All of that should be kind of decided based on those market cycle rules. And this is kind of a good encapsulating point here. Here at the top, we have Reddit, which was one of the key leaders during that strong uptrend into the end of last year and even into the beginning of this year. We've got Palantir here as well, another one of the key leaders here. And then we have the QQQ. So here was the chop phase here. The Fed changes tune on this day, but Palantir and Reddit still had a little bit of juice in it. They were probably the strongest stocks. Nvidia and MSTR, which were the best leaders before that, had already kind of topped and done their last exhaustive runs. And these were kind of the two key names left standing. And what did they do before the market broke down below their 21 EMA? Well, we had a breakdown below the 21 EMA here on Reddit and starting to live below it. And Palantir, a few days before the market really broke down, it was short-term extended. And then in one day, I think it dropped 8 maybe 10%, or I'm not quite sure, but it broke several lows at once and really changed the short-term trend of that. And these are subtle signs that you want to be watching for. When the key leaders start breaking below moving averages or breaking a lot of lows at once and just changing character in general, that might be a tell to say, hey, become a little bit more defensive, because a correction could be coming soon. We never know how bad it's going to be, but it can give you a heads up and just let you be in a more defensive mindset and protect your capital that much more, when we begin a new downtrend. And then Palantir as well, you can see how it shapes us versus the QQQ. You can see how this low relative to where the QQQ's low is much tighter and closer to its previous low. Again, just showing relative strength. And this happened, I don't have it on this chart, but above the 200 SMA. And this broke well below its 200 SMA. And just obviously this is a little bit of an older slide, but this was still below this 200 SMA, as the Palantir was already above its 21 EMA and 50 SMA and rocking and rolling. So that's a good slide to kind of, encapsulate why it's important to watch the leaders, both to the downside as early sell signals and warning signs, as well as to the upside when a new uptrend is beginning. All right. So early uptrend, this is just a quick review of, what to think about early in an uptrend as we're forming higher lows, reclaiming moving averages, and leadership shapes up. The goal during this period is to gain exposure to the top liquid ideas to test the uptrend, and then listen to trade feedback and manage your open risk. And make sure that if things roll over, you're not taking too much of a hit. But if things work, you're increasing your exposure, as Wes and Roy showed how they were, to participate in the uptrend and move your portfolio forward. Early in the cycle, there'll be a lot of noise, uncertainty. This is why we need a system to define our actions, and then just simply let the market show us what to do. One of my favorite quotes from Nicholas Darvis is basically he puts on a trade and then he says, and then I let the market decide what happened next. Either you get stopped out or you don't. And that's valuable feedback that can then tell you to be more aggressive or defensive. Gap ups, breakouts will be doubted early in an uptrend. Trust your system and your risk management process. Gap ups are almost more powerful during new uptrends because nobody trusts them, versus later in uptrend, the third gap up is more likely to be sold into and be an exhaustive gap versus one that you'd want to really position and be able to ride for that entire kind of earnings cycle, the trend between earnings reports. This is just a quick note on some things to be doing during a correction to really be ready and identify, again, the Palantirs, CrowdStrikes, MSTRs early on, so you know which ones to position. Basically, each day you want to kind of build a consistent relative strength list. Just make a quick list, go through your screens, and jot down any names that are standing out in terms of holding above moving averages, reclaiming moving averages first. On a big red day in the market, when the market's gapping down on bad tariff news, which stocks are staying green or staying positive. Note those type of stocks and look for themes among them. And here are some quick things to look out for. Look for stocks and themes that are holding well when the market is down big, holding above moving averages, forming higher lows as the market forms lower ones, consolidating sideways as the market really trends down or makes another leg down. They're bouncing the strongest after the market puts in a key local low, reclaiming key levels first, breaking out first through levels, highs, all-time highs, and also entering RS phases. And RS phases is just when the relative strength line is above its 21 EMA. So we'll show that in a chart in just a minute on some of these leaders. But these are some things to look out for to identify what the leaders are going to be. And if you were looking for these things, you identified Palantir, Hood, Uber. These are the key names that have done tremendously well early in this uptrend. We'll see how things go from here, but this is how you spot them early on, so you can buy them on that first higher low or first pullback to the 21 EMA, or the first breakout, pop above the 21 EMA, or the first range pivot breakout. This is how you spot them early, so you're ready to act when that setup occurs. Here is a quote that just kind of shared my RS list and the names I was watching during this period in the market, where again we've put in a bottom, we've had this tremendous bar, and now we're consolidating. We see a lot of names that have done really well: Lore, Hood, CRWV, Cyber. That theme has been doing well. CrowdStrike, Palantir, Gev, RBRK. So Titan, GRPN. How did I find these names magically early on? Well, I was just trying to kind of pay attention every every day and see what was holding up the best, what was holding above moving averages, what was bouncing the strongest over the past 5 days, and 5 days because that's when the local low happened. And I kind of run a screen in deep view. We've got data points that look for performance over the past X days. And right after a market correction, there's a golden nugget for you guys that write this down. If we're 5 days past the local low, run a screen or sort your screen by percent change from, over the past 5 days. And that will show you the stocks that are bouncing the strongest since that market low. And some of them are going to be destroyed. They're well below moving averages. You want to kind of ignore those or just keep an eye on them. But the ones that are holding up well, forming more mature bases, reclaiming moving averages, those are the ones you want to have on your radar. And a lot of these fit that bill. And actually my focus list from these were these 3: Palantir, Crowd, and Hood. So that just kind of to show you the value in doing an RS list every single day, doing your homework, because it's going to set you ahead. And when the rally, if it does materialize into something real, which this one has so far, you'll be well ahead of the curve, be hopefully positioned in the leaders, 3, 4, even 5 of the leaders, and benefit from the natural breadth expansion that we see early in uptrend. So that's a quick thing on RS lists and kind of showing kind of what mine was during this period in the market. And then a big reminder that I want to emphasize here is, we're still so new in this. So, this, like Wes pointed out, we're maybe a week, 2 weeks, 2 weeks and a half from when we just reclaimed the 21 EMA. We just reclaimed the 200 SMA. And there's going to be time, even if you're not positioned here, the leaders that made their moves are going to set up the next buy points. They're going to pull back into the moving averages, pull back to pivots. And naturally in the first few weeks, 4 weeks or so of a rally, there's breakouts. And this is a similar graphic that I made back last year, analyzing that correction, the names and how they broke out from there. And you can see that even a bunch of weeks later after this market bottom, sorry, I'm trying to zoom in a lot here. There were names that were breaking out, GPS, ARM broke out here, Path, GTLB, Affirm. So again, the point here is that even several weeks after the market reclaims the 21 EMA and reclaims the 200 SMA, there's going to be opportunities. So if you feel like you've missed this uptrend, where maybe in the first or, early second inning of this uptrend, if this really materializes into something great. So don't feel pressured, find those low risk buy points, and just be patient, and the time will come to be aggressive. And right now we're kind of almost in this phase where we're potentially short-term extended, and maybe the rally is still just getting started. But here, what we have here, we've got a week-long consolidation that set up new buy points, new pivots, and that'd be kind of what to look for if you don't have too much exposure already here. All right. So getting into this a little bit, and like how to trade a PLTR or hood if you spot it early. Trading a base playbook, these are just kind of the things that I look for. Watch for an extension down or gradual bottoming / tightness action at the lows of bases. Look for a sign of power off the lows, strong bounces off the lows. Look for the formation of the first higher low. As the base matures for entries, look for tight areas, moving average reclaims, constructive pullbacks, or other entry tactics as the stock is generally moving up the right-hand side of its base. This could be, again, a pop through the 21 EMA, a pullback into that 21 EMA as it forms a higher low, and then a reconfirmation up through an early buy point, a cheat area, something similar to that. But what's important is, these entries should allow risk to be managed. I like to do under, 4, even under 3% risk using oops reversals and other entry tactics, but you want to keep risk very tight here. So if the market rolls over, you're protected and you're not losing too much of your portfolio. And then I like to look for full positions before the standard base breakout through the pivot. Palantir just had it today, but there were opportunities where you could already be at a 30-40% cushion if you bought early in the base while managing risk very tight. But yeah, as I was saying, when a stock approaches the actual base pivot, often it's in the eyes of everybody in the market. And I'm always trying to, establish at least a starter position, beginner position before then. So I've got a cushion going into that volatility that often happens near that base pivot. All right. And this is just an example this is a great example of app back in the fall. We have that extension down, power off lows, the higher low here, reclaiming the 21 EMA, and then it sets up a nice tight range entry here. So even if it broke out here, you think it missed it, it experienced that volatility near that base pivot, pulled back into that 21 EMA, and set up a really nice pivot here. and we all know what happened. It doubled or even more from this point. So be patient, look for the lower spots. Everybody who missed this day right here and were in position feels like they missed the stock, but you just have to be patient and wait for the next buy point, because often, the best leaders, if they're going to double and triple or even more so, there's going to be plenty of other low risk opportunities, pullbacks to moving averages, fresh breakouts where you can jump on to that trend. All right. And I'll go through these pretty quickly, but I'll probably send the slides to Roy, or you can email me at richard@tradeline.com and I'll send you the slides. But this is just kind of doing a few case studies of some of the different key leaders. This is Palantir. Again, base above the 200 SMA, big oops reversal here, which is basically when we open well below this low right here, the prior day's low, and rally back through it. This is a potential entry point, but often, with extreme volatility, it's just a good sign of strength. And then we rally above the moving averages. We pull back to the 21 EMA. You could build a position here and range breakout, and then you're on and got a nice cushion going into the base pivot. You could have held through earnings, at least part of your position, and even added back anything you sold before earnings, at this bar or this bar right here on the fresh breakout. So this is just a quick annotation of Palantir. And again, if you want to look at this more on your own time, feel free to do so. Here's Hood, same type of playbook. Again, reversal, extension off lows, reclaiming the moving average, tightening up the moving average. This is kind of your first potential opportunity. Rallies again, sets another opportunity against the 21 EMA below this pivot. And then we get reconfirmation, then we get this recent extension. And, I saw a question from Arnold, I think, talking about, the future, where would future spots be? Well, if you look to the left, you can see potential resistance up here. We're approaching that. We're short-term extended into that level. So the next opportunity might be a handle that sets in here against the increasing 21 EMA. That would be a spot to look at, both in the stock, in Hood, as well as in the market at large. Right now at this point, we're a little bit short-term extended. We've come a long way over the past 5 days, but that doesn't mean we have to pause. Again, the market's going to do what the market's going to do, and early in an uptrend, we can seem overbought for a lot longer than, we call those lockout rallies, right? So you might have to be creative and find an oops reversal or a spot against a 10 EMA to position. But that's why it's important to do your homework early, have the RS list early, so you can be trying to pick up Hood at this spot or against the 21 EMA or on the reconfirmation or the gap and go. So these earlier buy points, that's what you want to be focused. But if you're not already in, we're still below the base pivot breakout. So technically we're still early. So if it pauses, sets back up, that would be a spot to look for. Then we've got HIMS. This is a much more of a faster mover. I wouldn't necessarily call this a true market leader quality. It's a little bit more of a momentum type name versus a market leader, but it's in play. It's got a theme, which is the weight loss, diabetes movement. It had the catalyst partnership with NVO to offer their drug through the platform. It had a gap up, a really tight day. And this is a subtle thing that I look for, really tight setup days, because they can set up a good pivot through the highs, and then it broke through and it's been on fire since. On the earnings, where it reported earnings, this was the first opportunity buying here. And then the second opportunity was on the oops reversal after it gapped down on earnings and immediately rallied through. And I did a write-up for TradeLab on actually both this setup and this setup, if people want a little bit more information. And then right now, again, it's such a powerful trend, but short-term extended, it's kind of in no man's land where, for our style, the number one thing is, can we manage risk? Is this a tight and logical entry from a setup that we expect can see an immediate move? And right now it's already making an immediate move. So you have to wait for that next contraction, the next pullback, the next key resistance line that might break through. So that's HIMS, another really powerful opportunity during this uptrend as it stands. Here's MSTR. I know you guys have been trading IBIT, Roy and Wes. This is the stock name to trade when it comes to crypto related. It had that same thing, reversal down, but I think this is a really key thing to point out in terms of looking for relative strength. We've got a move lower here, but we don't actually break these previous lows. And as dramatic as this pullback was, we weren't able to really break much below the 200 SMA, and we immediately rallied back up and again held above these highs right here. So a sign of relative strength that really claims the 21 EMA well below before the market, forms a tight area here, breaks out, sets up really nice and tight on top of this pivot, and has just been really trending and re-breaking out above the 10 EMA ever since. So, not much to do here if you own it. Just trending above the 10 EMA, trim and trail, and watch for definitive break below those moving averages. And, IBIT, Bitcoin might be just getting started again, just moving up the right-hand side of a base. So we'll see if this can have a really nice trend like we saw in the latter half of last year. Here's Tesla. Again, this is another sign of relative strength, even though it was pulling back, and this is in more of a significant decline than the other names we talked about. Most of these were forming their bases around the 200 SMA, but Tesla is the type of name where when it's in play, it can make a dramatic move. We saw that in 2020. We saw that a little bit to the end of last year, and we have had a significant decline. But again, this last pullback in the market, we weren't really able to make any more downward progress. There's some accumulation going on by the largest funds where they're saying, all right, we're comfortable accumulating Tesla within these prices, and they're absorbing any supply that's coming to market. And after such a significant decline, we're looking for the type of bottoming type action, bottoming base, higher lows to form. We get a first higher low here, we push higher into the resistance level, and really this was actionable. And the best buy point was last week. You can see how we pulled back into the 21 EMA. These two very tight days. And I talked about this in real time in the trade lab. Again, this isn't hindsight. You've got to pivot through these highs, breaks higher. You've got another buy point popping through the 200 SMA, and now it's kind of out in the woods here. We're a little bit short term extended. Strong reconfirmation today, just breaking out of this bottoming base. And basically, you'd be watching for the next higher low against the rising moving averages if you're not already in this name. But again, this is so early because this is just moving off the bottom here. If it's actually going to make a meaningful trend, it's still well below all-time highs. So there's time with Tesla if it's going to set up and keep moving. Here's Uber, the day before and today made really nice moves. Again, we've got that reversal extension, oops, reversal off lows, reclaim of the 21 EMA. These are just kind of things to mentally check off. Higher lows, retesting the moving average from the top side and holding. That's the key thing to look for. Tight ranges, and then it moves higher and then forms a nice tight range on top of the base pivot that really was set up from the base that's about 15 months long. So from big bases come big moves, and this is exactly what we're looking for. And we formed a nice tight range here, top side pivot through these two bars here, pulled in and then rallied, and really strong close on Friday. That was the time to enter right here, or even against the base pivot, managing risk a little bit lower. And then you've got a nice fall through. This is what you want to see on a base breakout. Just keeps going, and we see successive buying the next day, even the day after that, getting you at a profit right away. So that's another good case study here with Uber. So again, here's the trading a base playbook. These are things to look for as the market is bottoming, as stocks are bottoming. First, look for an extension down or gradual bottoming tightness action. Look for signs of power off the lows, relative strength holding above the moving averages, strong bounces. Then look for the formation of the first higher low. And then as the base matures, look for entries from tight areas, moving average reclaims, constructive pullbacks into those moving averages, or other entry tactics as the stock is generally moving up. And we want those entries to be tight and logical, allowing you to manage risk under 4%. And then ideally look to have a full position before the standard base breakout, or maybe accumulate 2/3 and add that last third or fourth on the actual base breakout when it confirms that it's actually starting to move. And then simply manage the position versus uptrending moving averages. Keep it simple. That's what we want to do until it actually starts breaking down. Try to keep that trend going and participate. So that's a quick run through of those case studies of the top names here, how they form their bases and best opportunities so far. Then I want to cover a key level, building a market cycle system, because that's really the nature of today. Why is this so important? So we'll kind of run through this quickly. If you want a really in-depth presentation, we did a whole webinar on this process, and I can send Roy the link, and you guys can take a look at that as well on your own time. But again, what is a market cycle system? It's a system for defining uptrends and downtrends relevant to your time frame and how you trade different phases. Early in an uptrend, in the middle of an uptrend, later in the uptrend. And this is one of the key things to go from a beginner trader, an up and down trader, a boom and bust trader that gives back a lot of profits at the end of cycles, to being somebody who performs and compounds and really can make progress from uptrend to uptrend. And what's great about a market cycle system is it gives clarity about when and how to enter at the beginning of uptrends, and when and how to exit when those uptrends end. And clarity gives confidence when you're trading, and confidence is key and allows you to really execute to the best of your ability. And, market cycle system, Roy and Wes talked about what's included in theirs, the different indicators they're looking at, the MACD. I know they look at net new highs, new lows as well. All those different factors. It can combine market index analysis, trade feedback, market leader analysis, and then any other indicators that they find relevant. One thing that I would suggest if you're just building your first system, keep it pretty simple. And don't try to get too complex too fast. Incorporate name, Zweig, Rethros, all these different factors until you've built up the experience, built up the confidence and the know-how to, keep track of all those things at once. Keep it as simple as possible. It's like a routine. You want to be consistent first, and then you can add bits and pieces as you gain more experience. So why do you need a market cycle system? As O'Neill says, 3 out of 4 stocks follow the market. This smooths your equity curve and limits drawdowns as much as possible. And during a new uptrend, you want to be participating and following those 3 out of 4 stocks. So that's why you want to be positioned early in an uptrend. Here are the general phases of a market cycle system. Again, early uptrend, middle uptrend, late uptrend, along with what's going on maybe with the market leadership and key news events. And then early downtrend, news might still be positive, but market adds negatively to sharp negative news. Middle downtrend, news gets more negative, rallies entice people in. There's high volatility, gap ups and downs. And then late downtrend is kind of what we've seen in April, is we see exhaustion, large swings, but not much further downward progress. And new market leaders start standing out, holding up moving averages, and just show that they're under accumulation and are beach balls underwater. So that's kind of what we want to look for late in a downtrend. And then trading early downtrend just from a high level, we want to start taking positions when our cycle goes into an uptrend. Early on, breadth expands, stocks should naturally build profits for you. And as Roy has mentioned, progressive exposure allows you to build full positions, and versus full positions, depending on your experience level, you can use either of those tactics. Progressive exposure, I know Roy's done presentations on this in the past. Basically, it's listening to trade feedback and scaling up and down depending if you're giving positive or negative feedback. You can start with half positions and go quickly to full if those positions work for you. And you can also think of in terms of total open risk. Are you risking 1% of your account, 2% of your account, and are you comfortable risking that amount in order to potentially gain 10% or 20% if that uptrend actually takes hold? That's the question you want to ask yourself. And then here's some quick math and an example behind progressive exposure. Again, I went in a little bit more detail in the full webinar, but this just is some math example about, trying 3 stocks at 10% positions with 5% stops. And then the result, one of them is stopped out, the others gain a little bit. So overall, your portfolio gains a little bit. And then you can start to scale up a little bit. Instead of 10% positions, go to 15% positions. And again, one stops you out, the others work, and your original positions still are rallying as well. So at the end of the day, you've got 3% equity gain. And this, for instance, could happen, early on in a market uptrend. So you've got now 3% equity gain that either is, profit cushion to try other positions, or you can just hold these ones and look to add and just increase exposure as you go. So that's kind of a math example about how you actually apply the concept of progressive exposure. This is another way, or a way to kind of start your initial exposure level, is using index ETFs or leverage ETFs to put on that initial risk. A 20% position, which is pretty high in the TQQQ, with a 4% stop, is only risking 0.8% of your portfolio. So yes, this is a big position, and maybe even 10%, and then be risking half of this. But this is a way to quickly gain exposure, and then you could either look to hold this on as a trade or sell this into strength if the market rallies, and then that would finance other trades that you could make and start actually putting money to work in the market leadership. So that's a quick example using leverage ETFs. Then just 7 key steps when creating a market cycle system. First, choose your time frame, relevant indicators, start simple like I mentioned, study history, and then basically test and iterate as you go. So here's testing your time frame. I incorporate more of a swing trading style. So my market cycle system is going to go from base to base. And I like to use the 21 EMA, while someone else, a more longer term investor, might use the 200 SMA because their time frame's longer than mine. My goal is to capture momentum moves, and the 21 EMA does a pretty darn good job of accomplishing that. So I'm using the 21 EMA and the QQQ ETF to kind of turn on or off my market cycle system. Here's some other relevant indicators. I know Roy and Wes mentioned other ones, but these are some ideas that you can use. But again, think about what makes sense for your style and how you interpret the market. Don't use the COT report if that has nothing to do with how you find stocks or decide to trade. Use something that is relevant to the style that you learn or the traders that you look up to and are learning from, what they find relevant and consider. Step 3, again, start simple. Just the very simplest, using a moving average. If it's above the 21 EMA, we're in an uptrend. If we're below the 21 EMA, we're in a downtrend. And this will work actually pretty darn well to keep you on the right side of the market in general and get you out of the worst of the declines and get you into the strongest uptrends. And then studying history, you want to kind of use the rules that you start with and look back in history and test it. How did it perform? Did it get you into the uptrends that you'd want to participate in? Did it get you out of, the worst corrections like this simple market cycle system did? Yeah, this is just more studying history, going back to the last year in the fall. It turned on here, got you out a little bit here, turned back on, and then got you out for this, out of the worst of this correction. And then again here, got you out pretty close to the top. Studying history, this is going back to 2022, the start of that bear market, got you out right here. This is going back to the beginning of the new bull market in 2023. This is us breaking above the 21 EMA, and this started, of course, the nice move in 2023 through 2024. And then this is back the COVID correction, where again we see the extension down, move into the 21 EMA, base, higher low, and then pop through. This is pretty similar to what occurred just recently. And then the trend, of course, began. And then this is later on another correction, got you out here, not too close to the top. So again, no market cycle system is going to be perfect, but you want to have a general guide about should I be aggressive or defensive in the market. And this is a pretty helpful way to do that. This is back in 2009, the bottom. How close did it get you in to the bottom? But look over here, there's also head fakes where it got you in and then you got stopped out. Got you in, got you out. Again, no market cycle system is going to be perfect. And that's why I like to combine the 21 EMA with also what the market leadership is doing. How are those bases shaping up? And that will help, inform you a little bit if the market rally is actually going to take hold. But there's also going to be times where you enter and are positioned and managing risk and you get stopped out and you roll over. But again, we're looking to risk 1, 2, 3% of our portfolio each time. And then when it actually works, all that, all those losses will be more than well and paid for when we catch the real trend and the new uptrend. So this is, I think 2016 here, got you in before that big move. And then when you're studying these historical moments, write observations, think about the flaws and the pros and cons of your market cycle system. Does it get you out, too often where there's false signals? When does it work well? When does it not? Think about that. And then think if there's ways that you can make it a little bit better. Again, try to keep it as simple as possible. And these were some notes based on observation I made regarding the 21 EMA. And then here is, building market cycle rules about that. Market uptrend is defined as 2 closes above the 21 EMA. And a downtrend is defined as 2 closes below the 21 EMA. And in an uptrend in the first few days, start with half positions with positive trade feedback and progress, scale up quickly to full sizes. And then in a downtrend, first, no new buys, consider selling partials on weakest positions, and then treat individual positions on their own sell rules that I have in place. And then step 7 is just to constantly iterate. If you establish a market cycle system and go through multiple cycles, you'll start to see ways that you can improve it, ways to make it a little bit more efficient. And you just want to keep doing that to eventually come up with something that, like what Roy and Wes have done, where they stay on top of the market based on how they interpret things and are very comfortable putting on risk when their market cycle system says, let's go get aggressive, and, stepping back when things get more of a defensive environment. So again, here's the market cycle system that you could, finally implement. Uptrend defined as 1 or 2 closes above the 21 EMA. Downtrend defined as 1 or 2 closes below the 21 EMA, and also considering the setups / breakdowns and action of the leader. So this is pretty much my market cycle system as it stands today. And my rules are, as the market and stocks look set up to start an uptrend in the next few days, getting close to that 21 EMA, look to position up to full positions in 2 to 4 top ideas or the TQQ, risking around 2% of my overall portfolio as I'm trying to get positioned initially in those names. And then with positive trade feedback and progress, become more aggressive and increase exposure. And then a downtrend is pretty much what we had before. No new buys, consider selling partials on weakest positions, and treat individual positions on own merit based on cushion, but protecting profits is goal number one. So this is pretty much my market cycle rules. So key reminder, simple equals robust. And the closer signals are to price, the better in my mind. But also, breadth can be very helpful. Watching the leaders is very, very helpful. So again, there's no perfect system. Some will act too late. Others will give you too many false signals. Study and find a way that works for you and just iterate over time, and you'll figure something out. Breadth, thrusts, oscillators, indicators, study it for yourself over many market cycles before adding it to your process. Borrowed conviction is not enough, and you'll have much more confidence in something you've gone back and studied how it acted in 2009 or the 2001 scenario, or in the 90s, all of that. So study stuff as much as you can and find something that truly makes sense to you. So key summary, market cycles are a technical representation of human psychology. Cycle phases determine the effectiveness of different strategies. There's going to be better strategies early in an uptrend, gap ups, which are doubted that then late in a trend are more likely to be exhaustive. And then basically you need a system for determining these phases and how to act during each one. And a market cycle system, again, is a key differentiator between beginning traders and more intermediate and advanced ones. It helps smoothen and enhance your equity curve, manage risk, and at the end of the day, limit drawdowns, which is, our key goal. So that's pretty much the main presentation. I want to talk a little bit about the Trader's Handbook, but before that, Roy, Wes, any questions about the actual presentation before I talk about the book a little bit?
No, I don't have any.
There's a question from Arnold. Once an ETF like the QQ reaches its previous all-time high, should you keep holding long-term or exit and re-enter at a lower price? A breakout at an all-time high is bullish. It all depends on your cost basis. If it's in trend above the 21 EMA, and that's my rule, I'm going to keep holding until it breaks below the 21 EMA, and the all-time high breakout is just a positive sign. If it breaks above the 21 EMA, stalls, and then looks to break lower below the 21 EMA, that's when I would act, because that's my sell rule. But I don't want to say that it's always going to sell off of the all-time high, because if you look back in history, we make all-time highs a lot more often than, basically all-time highs are a very bullish sign, and the market over time keeps going higher. So you want to listen to your sell rules and help that determine your actions. Wes, did you have anything you wanted to add or any questions?
I don't have any questions. I thought it was just an excellent presentation. I love the examples, and I think maybe Roy was talking about this before when I stepped away for a second, but I love coming to the same conclusion as people like you. Well, not just following you on Twitter and saying, "Oh, those are my ideas," just kind of seeing the same thing. I think it's very interesting, and it seems to have guided us well. The same kind of method. Very, very similar approach to this bear market and rally. We've really looked at things the same way. It's pretty amazing.
Yeah, I will make one point, and that is, Richard, was I correct in assuming that you basically taken everything from all these interviews that you conducted over the years and synthesized that to come up with this, developing your market cycle system?
Oh, sorry. Was that a question?
Yeah.
Yeah. 100%.
Yeah.
And
Yes.
if you think about it, William O'Neill, his follow through day is a market cycle system. That's what he's studied and worked for him. Everybody's going to be a little bit different. I'm influenced very heavily by Oliver Kell, the U.S. investing champion of 2020. I've learned an immense amount from him, and he has his own market cycle system using the 10 and 20 EMA, which I know you guys look at as well. But basically, they're trying to define trends. And every market cycle is going to have a slightly different way of approaching that based on if you're more aggressive and you lean towards shorter to moving averages versus if you're thinking a little bit more long-term, you'd look for more long-term signals. But I think it's really key to create something that's unique to you and you have confidence in. I think if you can take away one thing, you have to build confidence in your system, because otherwise when it's time to go long, your system, your rules say you have to put on exposure, you're going to hesitate, and then you're going to miss the low risk buy points, and then you're trying to play catch up, and it's kind of a cascade where you messed up initially, and now it's a lot harder to get to what you want to do. Yep. So I think that's an important thing to say. Perfect. Yeah, Wes, anything you want to add on that?
No, well, there was a question, and we get this question sometimes too. Like at the meeting last month, it was, "Hey, I haven't sold," and that was the day, like after the low. I haven't sold. What should I do now? It's such a hard position to be in because, like you said, if you don't make the if you don't make the right decision early on, it's going to hurt you. Just like now, right? I think someone asked, "Hey, I sold and I haven't gotten back in yet. What do I do?" And it's just it's a hard question, because we're not sitting here eager to buy new things either. We added 5% exposure today because we were already just heavily exposed. It's just time. We've got to see things digest, or I
Yeah.
would, if I were uninvested, I would have to wait. Otherwise, Roy and I are happy to do nothing, hopefully, for a couple weeks
Yeah.
and let them digest. Um, I don't know if the indexes or stocks right here. I don't think Robinhood's a buy like right here. But I think I'm comfortable letting it digest. Um, so for me, I don't know. I guess it's just somewhat try to answer that question if I can. I think you just have to be careful. We know we've been
Yeah.
overbought and we're likely extended and due for this pause after this
But
pretty
I
impressive
said
run.
we were due for a pause yesterday, and look what happened today. I mean, that's the
Yeah.
yeah.
Ha
So
ha.
yeah.
Yeah.
So
What do
we'll
we
see.
know?
Yeah. Awesome.
One of the things that we like to do also, Richard, is, and different people have different approaches to this, is like when you go through a bear market, like it was clear that we were in the middle of a bear market. And normally, I mean, you happen to show Palantir and I think Hood right there breaking back over the 21-day. And we had many stocks that were setting up sort of like that, but they weren't even above their 50-day yet. Also, a number of those stocks, hadn't recovered significantly enough. But you want to look at those stocks that have the best numbers, the best earnings growth, the best relative strength, the best, that have the broadest reach out there, in terms of their total addressable market. But we historically always buy the averages, like on the first follow through day. And because this bear market was so devastating, we didn't put, the triple or double ETFs on, the leverage ETFs. We just bought the single, ETFs. But we always, that's what we always do because we don't know who the leaders are going to be until normally a few days later. And it's only been 15 days. And, the power trend, probably it's going to hit Thursday. It's going to hit after tomorrow. And, that's according, to Mike Webster's work, that's the time to press the gas. And, the setups that we've had, we didn't have any right side base development. It was right off the bottom. And so but we had all these leading stocks had double bottom bases. So that was, that got you in all these leading stocks, the double bottom bases, not VCPs. Very few stocks, leading stocks, are putting in VCP patterns. So that's what's going to come as this market broadens out. We're going to transition, we're going to pause, come in, and that's the time you can, the next time to average up, into these winning stocks. That's probably the best way to handle. What do you do with the leading stocks now? You don't buy them; they're all out of their bases. You wait till they consolidate, maybe put in 2 or 3 week type patterns, and then add or initiate positions.
Yeah. Well said. I think that sums it up really nicely. Excellent. So I just wanted to speak a little bit at the end here about the book that we're putting out that will be released on May 27th. I think it fits a nice niche where, there's these fantastic books, behind me, How to Make Money in Stocks, Stan Weinstein's book, Jesse Livermore. But I think what we try to do with this book is really build a step-by-step process to, like Roy mentioned, synthesize all this amazing knowledge from these top traders, including, the top traders of, the modern era. And really break it down to how to create and find an edge, how to identify setups, how to manage risk, how to identify buy points, how to do post analysis. Each chapter in this book kind of breaks down one aspect of a trading system. One of them is building a market cycle, and encapsulate that in one resource there for you to be a trader's handbook. And like I say here, it leverages the ideas, systems, and setups and rules of all the traders, including you guys, who I got have had a chance to talk with, ask questions to, and learn how you guys go about it. So here's a little bit about why we wrote the book. My goal with my personal YouTube channel, the Traderline channel, the conference, everything I do on Twitter is to spread sound trading principles and methods and spread knowledge. I was lucky enough in 2019, somebody in the chat asked about how I got into this. I took a class from Dr. Eric Wish, who's a Can Slim Foundation trader, has been doing this for 50 plus years now. And I got to learn right from him in a small setting about how he trades, how he finds stocks, how he enters and manage risks. And not everybody gets a chance to have that type of experience. So the book's goal, everything I do's goal, is to teach the core ideas of trading in a simple but also in-depth way that can help you, along your trading journey. Everybody starts somewhere and everybody has to put in that work. But hopefully this book can, help prevent you from some developing bad habits and help you start new ones, good ones, and hopefully save you from some bad mistakes along the way. So again, it incorporates, Traderline's experience teaching thousands of traders, answering common questions, and hopefully preventing the worst common mistakes. It incorporates my knowledge, Ross Haber's knowledge, who worked hand in hand with O'Neill, taught his Can Slim workshops with him, managed millions of dollars, incorporates his knowledge and his vast experience. And that's in a nutshell why we wrote the book. Here's a little bit about what's in the book. Again, each chapter kind of covers one aspect of a trading system, from technical analysis and fundamental analysis, foundations, edges and setups, entry tactics and trade execution, risk management, sell rules, market cycles, stock selection, and screening. We really go in depth into what should be in your trading routine. We share a lot of screens that we use and can help you find, the Palantir, the CrowdStrike of that market cycle. And then chapter 10 is probably my favorite, the post analysis chapter. We really go in depth here about how to analyze and calculate the key numbers to look at, and then also from a single trade perspective, how to analyze how you did, how well you followed your plan, and look for improvements you can make in the future. And then at the end, we've got finding new edges, setups, entry tactics, how to basically do a study on a concept. If you want to study the Zweig breadth thrust, this would be a process that you'd follow to look for examples from the past, study what was going on in the market, what was going on with market leadership at those points. We share a process about how to basically do a study just like that. And then the last bit is a chapter of 200 plus annotated model book charts of top performing stocks from recent years, the past 10 years. So this is a great way to train your eye of what to look for in terms of, buying up the right-hand side early, or, trading earnings gaps, all of that. We kind of break it down there for you and give you a lot of examples, so you don't have to go searching and say, what are the best names from 2017, and then try to go look by one by one. We've got it all in one place for you, so you can study those charts and find new edges and just practice, your rules as well. Here's, a brief look at the model book chapter. This is one of the breakdowns of Uber from last year, looking for a lot of the things we talked about today about double bottom bases, reclaims and moving averages, what that looks like. So you can use this as a template, to trade in the future. Here's, again, my favorite chapter is the post-analysis chapter. I break down a trade that I made last year, and I do some tweaks too, so it's not all my trade, but pretty much, how I traded Reddit, got in before the earnings gap, how I managed it during using different sell rule techniques, and how you could tweak those sell rule techniques to basically improve your performance and stick with that trend a little bit longer. So that's my favorite chapter of the book, chapter 10. So is this book for you? I think it's best for traders in their first few years of trading who are serious about improving, but I think it's also great for more advanced traders who want to keep, learning. The post-analysis chapter, finding new edges, the model book chapter is perfect for the more experienced traders who've been at this a couple of years or, even a decade plus. And when I'm always, thinking about, should I buy a new nonfiction book? I respect the author. I've learned from them. Should I buy it? I always think to myself, do I think I'll learn at least one new thing or concept that can improve myself? And if yes, go for it. And I think there's plenty of nuggets in here for you if you're serious about trading that hopefully can help your performance. Also, I want to emphasize that along with the book comes a whole kind of educational course suite where all the webinars we've done, we've basically done a webinar along with each chapter of the book. That's included in this educational course, along with bonus articles, guides, examples, a companion workbook, and then additional model books, weekly chart model books of top stocks, base breakouts model book breaking down what to look for there, sell rules model book talking about different sell rules, market cycles model book, again studying history and seeing how trends begin, how they end, all of that. We'll have an exclusive Q&A session for people who have ordered the book. And then also recently, we've been doing some bonus webinars only reserved for people who have pre-ordered the book. We just this past weekend did the breakouts webinar, and then tomorrow actually is one on gappers. And I know Roy and Wes, you guys love trading gappers. You guys just bought Toast. It's a tremendous opportunity. I think a lot of people don't take advantage of it because it is scary to buy a gap up or buy shortly after a gap up, but there's ways you can do it while managing risk, and it can be a very great low risk buy point if you manage things correctly. So I'll talk about different techniques you can use in tomorrow's webinar, and then later on next week I'll be talking about trading pullback. So covering kind of three main types of setups here, really in depth, and I think it's a really good add to the book as a whole. And again, if you pre-order the book, you'll get access to all these different resources. Then, this is just, again, a little special offer as well. Just this week, if you pre-order, and you can scan the QR code to pre-order, I'll drop the link as well in the chat in just a second. But if you pre-order, you'll also get a $100 Traderline gift card, which you could use towards, the Oliver Kell Masterclass, or, one of the other resources we've created, Stan Weinstein, John Boyk, we did a great historical analysis masterclass. You could use that towards that as well. Again, you could scan that, and I'll drop the link in just a minute to the book. And then again, here's just the webinar we'll be doing tomorrow on gappers. This was coin on a catalyst of being included in the S&P 500. And, we'll talk about how you can manage risk on day one, and then strategies for day two, day 3 plus, if it forms a range, how do you buy that, identify a pivot point, all that. We'll talk about that tomorrow. All right. And then here's just an overview of the webinars that, again, are included with the book. These are the ones we've done so far. This weekend, we'll be covering post-analysis. So again, my favorite topic. We'll be talking on Saturday about trading analytics, and on May 18th, Sunday, how to analyze, individual trades. So this weekend's all about post-analysis, which is really key to establish a feedback loop to improve over time. If you're not studying yourself and studying your trades, you're not going to be able to identify your weaknesses. And, there's often a lot of low-hanging fruit that you can do, tweak a sell rule, tweak a buy rule, and you might not realize you're making a mistake over and over again until you actually look and mark up on a chart where you bought, where you sold. Early on in 2019, when I was first starting trading, I would always buy about 2 days extended and away from a contraction, away from the 21 EMA. And I only realized that by looking back on my trades and fixing that mistake, basically. And that really helped my performance quite a bit. So that's the type of stuff we'll be talking about this upcoming weekend. And then we've got building a model book webinar coming up, and then basically doing studies on May 25th. And then we've got a launch webinar talking about the book as well on May 27th. Here are a quick bunch of reviews. We had Larry Williams take a look at it, Deepak Upal, top performer in the USIC, Peter Brandt, Market Wizard, John Boyk, really nice reviews. We gave him a look before, and also we've got the esteemed Roy Maddox as well, very excellent trader who got a chance to look at it. And then Mark Minervini also says it's a great addition to any trader's library. So that's a quick spiel about what's in the book. Hopefully you guys will go ahead and pick it up. Definitely recommend pre-ordering it to get all those bonuses. And here's the QR code again to pick it up. And let me actually drop the link as well. And give me 1 second here. I'll drop the link in the chat so you can pre-order on Amazon there. I just dropped the link so you can pick that up as well. And yeah, that's a quick thing about the book. Roy, anything that really stood out to you when you got a chance to read it?
I was just fascinated by so many things that you covered in the book that we're actually practicing ourselves. I was just struck by that. I thought, man, I could have written this. I mean, not really. You needed 5 people to write it, but it's stuff that I've learned over the last 37 years as well. I mean, I think this is the best handbook that I've seen out there in terms of practically managing your money from a trading perspective. By far, number one.
And I love that your favorite section is or chapter is the post analysis because that's the hardest thing for so many people because it's hard to be honest, with yourself about yourself. And so it's kind of perverse that you are interested that you're that's your favorite
Yep.
thing, and it's just so contrary to what most people would want to do. Because yeah, if I had to go back and look and honestly look at man, I got emotional there, I got greedy there, or wow, why did I put that position on? I had no conviction, and I've made it way too big for
Yeah.
whatever bad reason. So it's cool to see that and I noticed on the Reddit chart too, right, how you got stopped out maybe once, and you called it panic selling, and we probably got stopped out of things multiple times that then end up being
Exactly.
your biggest winners, regardless. So it's yeah, I'm gonna enjoy that
Yeah. Awesome.
chapter, I
Yeah.
think.
And
You know,
go
I
ahead, Wes.
guess,
Oh, go ahead, Roy.
yeah. Yeah, I guess one of the things that, from a trader that you've got to understand is you've got to understand where we are in the market cycle. Again, if are we in an uptrend, downtrend, or are we just, floundering? Because, if you limit if you start taking 2% hits to your equity capital, and you have a large account, that starts to hurt. And so you've got to be prepared. I know when we initially put on our position on April 22nd with that 15% position, we limited our loss to 0.76%. That's where our stop was, 0.76% of equity capital. And so, and we happened to be right, and then we could build on it. We sized up as the rally increased. But if you're in a real choppy market, 2%, 2%, 2%, then before long, you're down 10, 15%, and it's tough to work your way back. So, you don't want to build out, you don't want to, dig yourself out of a grave, so to speak. So, I think it's reasonable to have 10% corrections, but, we're trying to keep our equity drawdown to no maximum 10%. If you can do that, you're going to be successful because you'll hang around, you'll get the, you'll finally get the trend right, and then the money starts piling in. And again, when I'm going to go over the stocks that we have in our portfolio, and we think we're set up. We think we're set up for like a 20% run right here in the stocks that we own. So it happens really fast, but you have to be in there to maximize the gains, and we're certainly in there for sure. And now we just need a normal consolidation that with the market to consolidate, these stocks to consolidate and hold their 21-day, EMA, hold them and just consolidate, and that'll set up for the next opportunity. Where the next opportunity is really where you're going to be able to size up. Here, this is all mostly initial positions, probing positions. You had to be really, really aggressive to go April 22nd and have 10 to 20% positions. So, that's important to incrementally and progressively, add your exposure.
Awesome. Yeah, I think that's it for me. So hopefully you guys check this out. And Roy, Wes, thank you so much for having me.